Hi, Donna Riolo, staff accountant with Riolo, Freddie & Associates. I mentioned in the last video when we were dealing with your principal residence the other exclusions that are available to you, one of which is called insolvency. And insolvency is basically a measure of your net worth at one specific point in time. And the point in time that really matters to you is in a short sale, the day before the close of escrow, in a foreclosure, the day before the trustee sale. Reason being is that those are the dates that your debt will actually be canceled with the bank. And the government says if you're insolvent immediately before those debts are canceled, then they won't charge you tax on the canceled debt. So to figure out whether or not you're insolvent, what you would do is use one of the worksheets that are available to you. You can find them at www.irs.gov. I've got a different type of worksheet that I use that's in a format where we can fill in the blanks and it'll spit out a number. But what you essentially need to figure out is, are your assets worth more or less than your liabilities? So in this scenario, we've simplified things. You've got $3 of assets, and that includes the value of your vehicle, the value of your checking and savings accounts, stock brokerage accounts, retirement accounts. And then on the other side, your liabilities, where we've got $5 of liabilities. And that is comprised of credit card balances, loan balances, vehicle loans. And keep in mind that on both the asset and the liability side, the house that you're selling is included in this calculation. So in this scenario, because we have $3 of assets and $5 of liability, this person would be insolvent by $2. And what that means is if you have cancellation of debt in the amount of $2, you don't have to pay any tax on it. If you have debt cancellation for $1, you don't pay any tax. If you have debt cancellation of $10, then we would be able to exclude $2 of it, and you would pay tax on the remaining $8. So use this format on a much bigger scale, and you'll be able to identify if you're eligible to use insolvency to exclude some of your canceled debt. Again, in the previous video, we discussed qualified principal residence indebtedness. You can combine that with insolvency, but insolvency is not limited to that. You can use insolvency for canceled credit card debt, canceled debt from your HELOC on your house, and you can also utilize it when you're dealing with selling rental property. So if you have rental property that's you're facing short sale or foreclosure on, this would be one of the exclusions that we would look to. For more information on this issue, visit my website at realestatestreettalk.com. Thanks.